Venugopal Garre, Managing Director, Bernstein. He joins us for a change live in our Mumbai studio. So thank you very much. Nice to have you in our studio. What brings you to India? Just routine visit or big block deals you're working on?
I just wanted to see why there is so much excitement. So routine visit, a lot of meetings, trying to understand also how the domestic mutual funds are looking at this sort of.
Did you see the new bridges in Mumbai?
Oh yeah, I did.
The metro construction?
I did. So
the airport has got a new look.
Exactly. So I mean,
So
every time
there is excitement.
Exactly. So every time I come, it takes much longer to reach places. But the reality is, you can clearly see the very few countries in the world where you have so much of activity, especially cities like Mumbai. But I guess it's a 5-10 year challenge for those who live in the city. But the reality is, after that, you're going to benefit from that. So that's the reality.
You know, while we may say, okay, India is in a pedestal positioning and we are a special situation market, but the reality is Nasdaq is at an all-time high. Japan has cut out loose after 20 years of a bear market. European markets are also doing well for themselves. While absolute gain may not be that large, but equities in general have done well. So how much of the excitement in India is actually global in nature?
No, I think I would keep India aside from Japan and US particularly. See, firstly, those two are developed markets. If you look at the last 10 years of the entire construct of developed versus emerging markets, developed markets have actually done really well relative to emerging markets. So as an asset class, emerging markets' potential for returns has been questioned, and that's the reason why there's been a lot of redemptions as well globally, which is the reason you don't really see too much of FII flows as well. And the second aspect is, if you look at the US particularly, we have seen a situation where there's a pretty large concentration of returns, for some stocks. But if you look at India, this is a very rare situation where you have pretty much broad-based returns. They might be just isolated few stocks, they may not have worked, in the amongst the top companies. One characteristic representation is, we were doing this report this week, I think we released on Monday, where we looked at the last decade of the 150 mid-cap stocks to see where the valuation bands lie. And we were actually surprised that about half of them actually traded 40 XP and 25% was about 60 XP. And this is the highest we have seen, actually even higher than GFC times. Okay. So that is the difference between India and the other countries, I would probably say.
Valuations.
But are India valuations a concern?
Definitely a concern. I mean, remember that valuations tend to be a concern, not always. They tend to be a concern when you tend to see momentum peak off, which is earnings momentum, and when you don't really see further earnings revisions. Alongside this valuation thing, if you see the number of stocks seeing earnings downgrades is higher than the number of stocks actually seeing earnings upgrades. Yes, we're still seeing some earnings upgrades, but the ratio is probably 40-60 now, with 60% seeing downgrades. And economic momentum is very good in India. There's a cycle brewing for sure, but remember that economic momentum is also moderating. You clearly see from the GVA data that came out, right? So that's not a bad data, but the reality is it is moderating, right? So that is not, the markets are basically not reflecting those realities at this juncture.
So in light of that, did the move in PSUs, what we witnessed last year, surprise you?
No, I don't think that was a surprise, because I was an outright buy on the market last year, right? So for me, it wasn't really about, a narrow focus on a particular sector or a particular category of market cap. We're pretty much an outright buy. Now the question simply is that PSUs in general, if you were to think about it, were very cheap on valuations, and in fact they are still cheaper than probably their private sector peers. The second aspect of PSUs has been that they are linked to the economy. There is no IT services PSU, there is no consumer PSU. So what is happening in the economy is basically you are seeing a lot of the real world, which is basically capex linked or things around that, primarily recovering. And so what you're actually seeing is also earnings construct of recovery, but I would just caution that don't call it as a structural change in how to approach PSUs. Nothing will change. It doesn't change in the world. Forget about India. Once your cycle is done and dusted with, then you will realize that, hey, you know what? We need to still focus on companies which can manage their own fortunes. That's the reason why people don't really invest in SOEs for the long term. These are good trades to have. And I don't think the trade is over. You can still be very selectively looking at certain areas where there is positive momentum still left for a few years. Maybe the returns will be lower.
Where is the positive momentum in?
Two areas which I think within the entire PSU pack where there is still momentum. Number one is, I would probably say, the entire financial sector.
Okay.
So pure banking, PSUs, remember there is no asset quality issue right now. PSU banks, the challenge used to be asset quality. That I don't think is going to be a feature for the next 2-3 years, asset quality. Number two is anything linked to power sector, for example, the cycle has only started now. It could be you can play an NBFC around that for maybe 15% more return, not a 70-80% return, but that's good enough compared to my own nifty expectations of 8% return this year, right? So you're literally playing for incremental returns right now.
Both the sectors which you mentioned, financials and power, they are regulated sectors.
Yeah.
And when it comes to regulation, it's anyone's guess that how much profit they can make, how much rate at which they can grow. RBI can come out and say, okay, your NIMs are highest, we need to moderate your profit. Power, beyond a point, the affordability of power is going to get out of whack, so government will have to come and say, okay, bijli ka price badha nahi sakte ho. Are you mindful of the regulatory part when it comes to banks and power?
Okay, so the thing is, there's certain areas where regulation is a bit more clearer. So, for example, if you are invested in a power sector utility, like an NTPC or Power Grid, you have a big clarity on what changes. It changes every 5 years. And you're more or less clear for the next 5 years, right? So, what you're playing incrementally is growth, right? And new orders, new opportunity goes for the cap goods supply chain as well. Banking sector is a bit more trickier. Level of risk definitely lower than what it was earlier, but then these interventions can happen from time to time with respect to who you're lending to and how much money you can make. So that is a risk that goes without saying, but if something happens to specifically on the sector, it's going to impact private sector as well. So you're again taking a relative call. So it's going to be a sector issue rather than a PSU issue.
Are you concerned about the recent RBI clampdown on both JM as well as IFL? I mean, NBFCs at large?
Look, it is always good to have a vigilant regulator.
Sure.
Because vigilant regulator ensures that you don't really reach a situation where you do nothing for 5 years and then when the bubble pricks, you have challenges for a decade. This is what happened in 2007-8, right? We all knew there was hardly any regulation at that point of time which was stopping irrational bids. Financial sector was lending without knowing what was happening. We had a 7-8 year downturn post that. So I'm pretty happy that these things are being very proactively looked at.
Nip it in the bud, I guess.
Exactly.
Yeah. What about the overall, digitization, Gen AI, a lot of these new themes that are picking up? How do you see that affecting the traditional IT players and some of the new age tech players?
See, the unfortunate reality is that I was discussing this in the morning with someone that AI, we are primarily again becoming consumers of AI. We should be in a situation where we should probably create companies which are able to not just benefit from the trend but also participate globally. This is the time where we should figure out, and I think at an organized scale the government should also be involved in that. Otherwise we'll end up using an international search engine or an international play store, whichever way it is, right? So we have no choice. The second aspect is, I've mentioned this last year as well, I think people are going to very soon run out of ideas internationally. How much of a semiconductor company listed in US can you keep buying? It's almost $2 trillion market cap. You look for new ideas and you need just a couple of $1 billion deals to be signed by these IT services companies, and suddenly people say, oh, you know what, they are also a play on AI. You need something like that to happen, but then it's not that they're going to re-rate like you've seen some of the global companies, but there'll be at least some excitement. I think that is the least we can happen for India, nothing more than that.
But while you can say that, look, Indian IT companies have survived the cycles. From Y2K, the migration was not sudden, it was structural.
Gradually,
They came out of enterprise to SMAC brilliantly. From SMAC to pure AI and digital, the migration is great. But with each passing generation, the growth has come down. So what was 100% growth became 30, 30 became 20, and 20 has become now 6 to 8. What P multiple do you think the sector will command when the growth at max would be 10 to 12% for next 2 or 3 years?
See, the simpler representation, by the way, 10 to 12% is an amazing growth to have. Consumer companies have 10 to 11% or 9 to 10% growth for the last decade, and they trade at 50, 60 XP.
Yeah,
because
even
remember,
70, 80
beyond the growth, these are companies with very strong balance sheets. They do buybacks, they have cash flows, they have decent ROEs, right? So you're not going to see a situation where the market rates at 25, 30 XP and you have these sectors trade at a significant discount, purely from an Indian construct as well. So they are now at fair value or average values compared to what they used to trade, not as frothy as we saw post-COVID. That itself is a good enough reason to probably reevaluate and sort of assess them. They may not make you a lot of returns because nothing changes in 12 months, honestly. And US is not heading into a recession. That's fairly clear. So that's also an added advantage.
When you speak to your clients, and I'm sure you get a sense of flows also, we saw one mini re-rating post the state election. Flows really came back. Everyone said that, look, the political uncertainty is now out of the window. Once the event risk is over, you never say never. It is still a risk. Even the markets are not factoring in that as a risk. I'm sure there are a lot of long only ETF, India dedicated funds. They would say, okay, we're ready to come back, but we want to come back after May. Do you think post May also there could be influx of flows into India once the election cycle is over?
My answer is no. I don't think there's any. I'm pretty sure there's no money waiting.
Okay.
I used to have this thinking a year back. The more I did work, I realized there's no money waiting to come into India.
जिसको आना था आ गया.
जिसको आना था आ गया. Incrementally, what is happening is, if you see this entire India shining story, which is real as well, being very well articulated by foreign investors, they're going around sending LinkedIn posts saying, hey, I was in India, I saw this bridge, whatever. The reality is they're not being able to raise money for China. They are seeing redemptions. So for them, their redemption for their own careers is to basically create another end market which has a future, which is India, and raise money for India.
So I look forward to LinkedIn post from you. Hey, I was in ET Now studio.
Of course.
But we did see a post on a bike that you had assembled. That was quite interesting.
This was 2019. Okay, this is an excellent bike, by the way.
Okay.
Cost us 75,000 rupees to build, and it was a motorcycle we built.
You built this bike for 75,000 rupees.
Yes, and it is basically a 50 kilometer range, 60-70 kilometer peak speed. And I would probably say the idea of building this bike in 2019 was at a time when a lot of auto incumbents didn't have any e-bike or e-scooter in the market. But this is a bike, not even a scooter. So we don't even have e-bikes much in the market. Yeah. And the idea of demonstrating this, that look, there is disruption ahead. If I can build a bike, then you will probably see 15-20 other companies do it. By the way, there are 400 EV companies in India trying to actually build some form of...
It's a functional bike.
It is a functional bike.
It's a functional bike.
Currently, what you see is it's displayed in our office, actually. But for 3 years, you know, it was fully functional, yes. I mean, it was being used for vegetables, but the reality is that it was working, but we were not taking it out on the main roads because, you know, this is, you know, per se, you know, a creation which is not a formal product, right? So, but it was working.
So 75,000, and I'm assuming that this must be with assembled parts. So when somebody is doing it at a scale, that 75,000 will come to 50,000 or 60,000.
Oh, that's right. See, this had a 1.5 kilowatt hour battery. Normally, you have about 3-ish these days. So at that point of time, if I had built a full-scale 3 kilowatt hour equivalent, as we call it, as, it would have been something like 85,000, right? But I paid 30% extra for every component.
Exactly. So,
right?
So what is the sum and substance of this? I mean, if you can make an e-bike, so then others can also do it with a little bit of technology.
I'm basically saying that IC engine, which was the core for a lot of these auto companies, it's a very hard task to build an engine at scale, a lot of capex required. You just can't go and buy an engine from somewhere, right? But in this case, this is like a smartphone in some way. I mean, more simpler than a smartphone. It's a plug and play. You can basically buy a battery cell and a BMS combination and just retrofit your bike as well. So the idea is it's not about retrofitting. The idea is that it brings down the fixed cost. So if you want to actually build an e-bike business, you can build it. You don't need to sell 2 million units a year. If you sell 300,000 units in a year on a fully variable cost basis, you'll make something out of it. That's good enough. You know, so you'll probably see 15 companies relevant in EVs rather than 3 or 4 today which are concentrated in ICs. Fragmentation of the market is a reality.
So who has the right to win in the EV space? Will it be incumbents or will it be disruptors?
You know, as of now, the disruptor is the market leader, right? We don't know whether it holds the market leadership position, but that's 3 years back as well, the market leaders were startups. Incumbents are coming from behind. Look, there is always an advantage of a brand and an existing distribution network, right? But even though EVs dismantle that advantage, there's very clearly that, but the incumbents might still have an advantage, which primarily means that they will probably still have higher volumes than a number 4 or number 5 player, but you could still sustain with more number of players in the market. That's the way it is.
And perhaps easier for two-wheelers than four-wheelers or passenger vehicles.
Yeah, so four-wheelers is very, very difficult to disrupt. So a lot of people will try. Four-wheels, if India allows foreign companies to enter, then there is disruption. If you full-fledged allow BYD, there's a problem. VinFast has entered India. We just recently had a chat as well with them. I mean, in theory, if they want to be, they don't have too much money, but if they want to be aggressive, they can disrupt the market. And VinFast is not a bad company.
Tesla may come in India.
Exactly. So, and they're going to tailor-make products. See, the entire EV world used to be about premium, right? We used to have higher price products. Yeah. And that's why we reached a sort of a point at which scale reached, like, let's say 20% of mix of a country, and then say, oh, we're not going growth. Second stage, every company in the world is trying to evolve sort of lower price products, $15,000, $20,000. That's where the entire EV market is moving towards, high volumes.
But granted to EV players, they have the following defense, which is that for ICE components, prices are unlikely to come down. But for EVs, prices will come down exponentially because mass chip production, mass battery production, battery accounts for 25 to 30% of the total cost. So affordability of EV will be far higher than ICE vehicles.
No, exactly, you're right. And I mean, battery technology is another area of focus, right? There is so much of development. Remember that this development is global in nature.
Yes.
So which is an advantage, and we also benefit from that, right? So that is one advantage primarily which is going to come through. Number two is it's not about fragmentation, it's also about micro segmentation of the market. See, if you want to basically buy a bike just for going for shopping 1 kilometer away, you don't need to buy a 200cc bike, right? You could very well buy a 40,000 rupee worth application which has got a 30 kilometer range, good enough. So it's going to also micro segment the market. That's, by the way, good for the two-wheeler market, that it could actually expand as well. But the reality is this is like too many products which are going to be available.
So net you're saying components are better than players.
So exactly. So component players are definitely the best approach, but then component players will be battery cell manufacturers. We need to figure out who eventually wins there. Motor companies, these are the ones primarily which we'll have to figure out. By the way, there are not too many components. That's the idea of an EV, right?
Yeah.
Everything else is traditional. So your tire or a seat or a shock absorber doesn't change.
The other sector which is seeing transformational change is energy transition. India is migrating from being a hydrocarbon dependent country to a alternative energy source. Now that's a big change. That means a lot of solar panels, a lot of wind power mills, changes in transmission, changes in transformation. Is that a multi-year theme, or that is a theme which is well played out and it's ahead of its time?
But it's very clearly a multi-year theme. It's only started now. See, the challenge of that at a utility scale is you don't really have storage at a good price or a good cost, right? And after 6 o'clock, solar is not going to generate power for you. So if you're able to get the cost of battery storage materially down, where a full system cost of let's say 5 rupees, that's going to be a killer, right? It'll probably take 6-7 years for us to even achieve that range. So, and once you reach that stage, then I think this is like going to explode materially. That's a way, that's a future. And remember that solar can be modular. You don't need to have a 5 megawatt or a 5 gigawatt plant at one go. You could pretty much have rooftops and manage your internal supply as well. So this is clearly disruptive. It just started.
So
even globally.
Let me phrase my next question in perhaps 2 or 3 parts. In this market, let's divide the market into 2 or 3 parts. What is cheap and growing? One. What is expensive but growing and you want to buy at lower levels? And what is expensive and not growing, where you want to say, look, just sell out and stay out?
This is in general on stock markets.
In general stock markets.
See, I think cheap and growing is financial sector.
Okay.
Even the private sector banks. There are episodic issues that we have seen. So I'm pretty fine with putting them in that category. I'll probably even say squeeze in a bit of IT as well. Second thing is expensive and growing is a lot of these consumer tech companies. They're expensive, but they're growing. And so there's not an entire reason to go out of it. We are not overweighted. We just move to equivalent, but we have specific companies that we do like, which is a Zomato equivalent or a delivery kind of companies, right? And I will probably say the third chunkage, which is expensive and not growing, is very clearly some of these consumer names where we are underweight. No reason to be in a staples. Even the previous cycle, it took 4-5 years of the cycle before you started to see volume growth coming back for these companies or for these sectors.
Asha, HUL is growing at 2%. And that is like a scary afterthought.
HUL.
Yeah, and they've done whatever they can do to. The Patanjali competition has died for them. Rural economy is picking up, but 2% growth. That just tells you that how well penetrated some of the categories are.
And before we let you go, I know you're an avid reader. Any recommendations that you'd like to flag off for our viewers?
Okay, so I just want to also highlight that I don't read any investment reports because I believe in creating my own investment ideas. So I keep away from that. So for the readers, I can't give them any investment reading recommendations. I would probably say create your own thinking. Books, that's what I'm saying.
Okay.
I don't read investment books deliberately by choice. I read a lot, but it is not books, investment books.
Forget investment books. It could be anything.
I'd probably say I like reading history. So there are a lot of these Vikram Sampath books which are very good, which I think people should read about history. So that probably would be one of my recommendations.
Lovely having you with us. Hopefully, the next time you come, you'll be zooming across one of these bridges and
on the bike,
reaching
On
us
the
on the
bike.
bike, of course, and reaching us a lot quicker.
Yeah.
Thank you for joining
Thank you
us
so
in our
much.
studios.
thank you very much.
Thanks.